Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Monday expert, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. How are you today?
I'm doing well. One of the things I knew I wanted to talk about today is I did a video yesterday. I have a playlist called Whiteboard that people can look at. It's basically me standing in front of a whiteboard. And what I did is I talked about the economy, the rest of 2022 and 2023. And the reason I wanted to review kind of my opinions is, frankly, back to our rich dad discussion, right? You read Rich Dad, Poor Dad, you want to be rich dad. I read Rich Dad, Poor Dad, want to be Kim and Robert. Our minds work different, and it's amazing talking to you. So if you don't mind, I want to kind of lay out 4 variables over the next 18 months, and I want you to highlight where I might be misguided. Sound good?
Yeah, let's do it.
So I'll let you pick. So we're going to talk about Fed funds, unemployment, GDP, and inflation. You can pick any 4 of those. I'll go in the order that you choose.
Yeah. Well, inflation's the hot topic on everybody's list, so let's get after it.
Okay. So inflation today, right? I had to pick something. I might as well use a government number. That way nobody can argue. Starts this discussion at 7.9%. That was the last CPI reading. I believe in my discussion yesterday, it's going to peak at something like 10.5, 11% sometime in the next 4 to 5 months. At which point, we will start to see what's called the base effect, meaning that you're seeing slower months drop off, where higher numbers are being added, and it will roll over. It will end the year probably north of 6%, so still not good. And then if you look at 2023, 18 months from now, we're still running north of 4%. So inflation is still going to be a problem. The Fed is still behind. It does peak this year. But it peaks over double digits, and it doesn't come down as fast as people want. So that's kind of my thoughts on inflation, again, CPI specifically.
Yeah. I mean, I can agree with that, all things being equal, but, if the war continues on and gets worse, that's going to drive inflation higher longer. If the pandemic rears its ugly head again and causes shutdowns like it's happening in China and in some areas
Shanghai,
in Europe, that's a real thing. That's your supply chain. We get a ton of stuff from China. So, that can continue to put pressure on inflation. But here's the big one that I'm looking at: deglobalization. So the war and the pandemic has caused more of a drive towards deglobalization. In other words, producing more at home. So we're not reliant on imports and, other countries for energy, for food, for all these other things. You're already starting to see companies like, New Balance, I think, came out and said, hey, we're ramping up production in the United States because we can't get stuff in. We're working deals out with chip makers, just all these different things. So, I think deglobalization is going to be a huge thing, especially when it comes to energy independence and, other areas. So that's going to continue to drive because it's more expensive to produce at home than it is abroad. I mean, that's why, obviously, we've gone abroad. So that's going to affect things and weigh on things.
I agree.
And then, wages. I mean, there's a lot. This is an employee market. So wages are going to continue to go up as long as employees realize, and the job market stays like it is. Employers have to compete. They have to pay more. They have to offer more incentives. That's going to drive wages up. And then that has to get, passed through, to the consumer in order to cover those costs. So I think you're on track, but I think it could be amplified even more than what you're saying if those other conditions continue to, exacerbate.
I think I love all of that. Deglobalization, risk to the upside. Wage inflation, risk to the upside. War and pandemic risk. Everything you went through, you're right. My kind of vision, everything I've talked about is kind of the best case, if you will, because everything you've talked about takes everything I said and moves it up. I mean, given I agree. I think deglobalization is a real thing. I think it's going to happen in force. I think it's probably 2023, not 2022. We're still stuck where we are today. But yeah, you're right. All of that could push, instead of 4%, maybe it's 6%. Wage inflation is legit, right? Again, people don't really get it. Wages are the largest component of cost structure for most companies. You're absolutely right. So
yeah, it's a big one. And, the interesting thing now is the Fed can no longer deny it. They can no longer say it's temporary, transitory, it's going to level off at the end of the year and we'll be fine. Now they're finally coming out going, we got a problem and we're going to hike rates 50 basis points, we're doing this, we're doing that, we're going to reduce the balance sheet. So they're getting it now and they're understanding it. at a level that they have to pay attention to it. And they have to now act versus just talk about it. Of course, they haven't done anything other than a 25-point basis hike.
Yeah.
So
let's talk about that one next, the Fed funds rate. Cause like you said, right, again, going back to CPI, Fed funds is now off zero. It went up a quarter, right? That has happened. Everything else is talking, as you're saying.
Well, it was point something. So it's like 0.37 or 0.39.
The effective rate.
Zero.
Yeah. The effective rate. Yeah. So what I see going on with the Fed funds rate is I think Powell is Bernanke. He's going to tell the market what's coming. And in the last 3 business days, which would be Wednesday, Thursday, and Friday of last week, 5 Fed presidents came out and said, we're going up 50 basis points in the next meeting. We have Goldman Sachs coming out saying, and like I've been saying for quite a while, they're going to do 50 basis points at the next 2 meetings, which is May 4th and 5th, and then June 16th, I think, something like that. So again, what I see happening is the Fed's going to be more aggressive. They're going to communicate. I think we end the year with the Fed funds at 2.75, maybe 3%. I think we end next year about 4%, which again, if you go back to my first talk on inflation, I still think the Fed at the end of 2023 is behind inflation. That's what I think is going on with the Fed.
Yeah. I don't think they're going to be moving fast enough, bold enough to really get a grip on it. It's going to take a while for that to trickle through. So they could raise the rates by 2% tomorrow. And the only thing that's going to do is affect the markets. It's not going to affect real inflation at the consumer level.
Not yet.
And raising interest rates isn't going to affect that anytime soon. So they really have that's the thing. What most people don't realize, they really have no ability to really affect inflation without really, affecting growth, throwing the economy into a recession, which again, everybody's recession, that's just negative GDP. That's all it is. Mm-hmm. And with prices going up, it's very hard to get negative GDP
exactly.
when you have so much inflation.
Yeah. So again, the only thing the Fed can do, they create demand destruction by adjusting the cost of capital, cost of money. And it does trickle through. It does take a while. So again, I don't see the Fed getting above inflation.
Not with a half a point. They need to come out Volcker style. What was he raising rates like?
Well, he did 26 times in a year. He did 21 of those on a Sunday, right? When the markets were closed. Because he was
How much was he raising though?
Was a quarter and a half.
Okay.
Yeah. But he raised, I think 1 month he raised it 5 times.
Yeah.
Right.
So they're going to have to get much more aggressive with either bigger hikes or more often, smaller hikes more often.
Yeah.
Because they meet monthly. A lot of people are asking, they meet every month. So, but they can do stuff in between, like you said, but they haven't.
A phone call.
So I think you got to see interest rates get way out of control. And that's where, okay, so what's the effect on the rest of the economy? So mortgage rates really through the roof. You want to see a tank in housing prices, you get up to 8%,
Woo!
6, 7, 8%, like we came from.
Exactly.
My first house, still a good, anything under 10% is a great interest rate, And I remember when I was happy to get under 10% for construction loans and development loans, and people just don't realize that. And the buyers out there, they haven't seen that, that are in the market right now. All they know are these low rates. And
it'll lock up. It'll
the Fed's got a huge challenge in front of them. And, they're trying to soft land things. And I just don't know if they can.
No, a soft landing, they stayed in too long, too low, too long. The soft landing is not possible. At least
they have to pick one. They either have to save the consumer or, save the market.
Yep.
Which one are they going to do?
Totally agree. That's exactly what I've said many times. So let's talk about GDP. So I think GDP is already low. I think it's right around 2.3. I think it stays low for the year, meaning below trend. I do not think it goes negative this year. Back to your point, it's hard to go negative when you have inflation. I do think we get negative. I'm calling for a negative quarter, either Q2 or Q3 of next year, probably Q3, followed by another negative quarter. So I think we end next year in an official recession. So again, my current stance is yucky stagflation, high inflation, low growth, ultimately ending in a recession. It's the only way out, in my opinion, is we have to have true demand destruction, which will mean negative GDP for multiple quarters.
Yeah, I'm not sure we get there because there is so much inflation that's driving GDP because prices are up. So you produce less, you receive more. So we're not measuring profits, we're measuring sales, basically.
Correct. Top line.
Production.
Yep.
And there's still a lot of demand out there. I mean, that's what we haven't seen. Even with the inflation that we're experiencing, we haven't seen demand drop yet. So unless you really get a hold of that and create, some demand destruction and really slow the economy down, and a couple of half a point rate hikes aren't going to do that. You're only talking about another 1% between now and the end of the year, probably, or 2%. Well, I guess if they're targeting 2.5 or 2.7,
it's 4 or 5.
And the amount of time it takes to get there, I'm not so sure, with where we're at, you're going to see that, because we're a consumer driven economy, and what people are, purchasing is what they're using to live on and consume. And what they'll cut back on is the big expenses. So, instead of traveling and doing a lot of different things, they'll spend more at home locally, which drives demand, which, so I don't know, it's just hard to say whether that's possible in the current environment or not.
Yeah. It's just certainly where I feel it certainly could be extended. Again, my big point here is I think this ends in a recession. I think ultimately at some point they've got to cry uncle and they got to smash inflation. I'm hoping it happens in 23, but it could be 24 without question. So the last one to talk about is unemployment. I actually think unemployment goes lower before it goes higher. I think unemployment today is 3.8%, U3. I think it goes lower. I think it probably bottoms out around 3.2, 3.1, 3.2. I think we have a bang up economy heading into the summer. The service industry, we just saw JetBlue hiring a bunch of people, begging flight attendants not to refuse jobs because demand is going through the roof. I think we've seen a lot of stuff, but now we're going to see services take off. That's going to lead back to inflation in wages. It's the time for the employee to have the power. So I think unemployment goes lower. And then I think we head into an environment where ultimately next year, as I called a recession, I think we have demand destruction. I think we have zombie companies going away. And I think unemployment is north of 6% by the end of 2023. It's kind of what I see.
Yeah. So, you're right. And we're already seeing it. So people are already having to go back to work because of inflation and the cost of things, especially energy. So, if inflation continues to get worse, then more people will have to go back into the workforce that exited. Their employers are having to pay more money to get people to come back because there still is way more jobs than there are, people willing to take them, especially in the construction and services industries. So that dynamic's got to change a little bit. And, at the end of the day, that all drives more growth. So, you've got more inflation, you got more people going back to work so they can afford, because if their houses are losing value because of interest rates, if the stock market's losing value, people are looking at their retirement accounts that they're going to have to replenish. So how do you do that? You do that by working. And then, that drives more purchasing power and, more goods and services. So it's kind of an interesting dynamic that we're in right now. We've never been in before. So there is no textbook answer. The economy's never faced a situation like this where there's more jobs than people willing to take them, record inflation, and asset bubbles all over the place. We just haven't seen this. So I don't know where it's going to end, but it's going to be fun to watch.
Oh, it's going to be messy. And again, I think the Fed, I think they've been trying to ignore the business cycle. They've been trying to manage out recessions. And as we know, seasons are real. Winter comes and winter goes. Good times never last. Bad times never last. It's a saying that you've given me that I just love. And I think
they've been relying on a textbook. They're not stupid people, but they're relying on a textbook that no longer applies. And they've been thinking more of, because of what happened in 0809, you got Neil Kashkari and a lot of people around that were in then that are, shell shocked from that time.
Yeah. PTSD.
Right. PTSD. So they're responding in a way to the pandemic that they should have responded in 0809. And that's what they're doing, is they're going, wait a minute, we didn't do these things back then. We could have saved the housing market and saved the economy if they'd have done half back then what they did now.
Oh, for sure.
All they had to do was just work out loans with people, that
entirely different. Again, entirely different ballgame. What happened last time is once you got 90 days late, you were 98% certain to lose the home. Today, they're like
PTSD from it. And, so do investors. And so do a lot of people like me. I look at the world very differently because I didn't think what happened back then could ever happen. I mean, I was one of those bull market price goes up only guys. It's real estate. You ain't making any more,
Exactly.
It only goes up, I
up.
didn't realize, and here's one for everybody watching. Guess what? Rents can go down.
They can.
Absolutely. They can. They haven't, and they've been exponential, but you and I have been through it, and we were going through it when the economy was roaring.
Yeah.
And we saw values of property and rents go down.
Yeah.
So
very cool.
It's interesting how those dynamics play out, and that, you can, behavior will fundamentally change through these events.
Yeah. So again, I kind of summarizing those 4 things again, go to my playlist called Whiteboard to see this full definition. I think we're in stagflation, which means high inflation, low growth. And I personally don't see an exit other than a true recession. You can argue if that's 23 or 24. Do you think there's any chance of a soft landing?
I really don't think so, because inflation is so out of control, and the employment environment, that dynamic is throwing a wrinkle in it that I don't think they have any bullets for.
Yeah.
I just don't think.
I don't think you cure it. Yeah, I don't think so either.
Yeah. You have to create demand destruction. You have to put the economy. So let's define soft landing. That means the Fed's trying to bring everything down and slow things down without actually putting the economy into a recession. That's what a soft landing means. Correct. Without tanking the markets, without tanking real estate values and all that. They've gone so far, so long with QE and with artificially low interest rates that they've created, and the pandemic with the supply chain and all that, has created this situation that we're in, that I don't think that's possible.
I agree.
I think the only way to bring inflation back into check is you have to create a recessionary environment for, some period of time.
Yeah. And just so people realize, I've done some videos on this. The average recession since World War II is 17 and a half months, with the longest being 31 months and the shortest being 1 month, the one that we just experienced in the pandemic. So, Greg, where can people find you?
Yeah, gregdickerson.com. That's where all my info is. YouTube channel, podcast. Go check it out.
Thanks, buddy.